Welcome to the daily update, where I'll go over the action in the market for Tuesday, October 8th, and then we'll see how things look for Wednesday, October 9th. We are pretty much range bound right now. We're still looking positive, especially when measured by moving averages. And because of the update, some of our indicators have improved, but we're getting some interesting signals from the VIX. And I have charts, I'll go through that. Just something to be aware of. And in the context that we're looking at, this could end up being negative. Now, we've been pretty slow this week as far as volume, but in Wednesday's session, we're going to get the FOMC meeting minutes. Sometimes that can move the market. We can see what they were saying during their last meeting, see who voted which way and what statements were made, and we'll see if the market reacts to that at all, whether it's positive or negative. So on one hand, we are still looking positive, but on the other hand, we've got some warning signs that we're keeping an eye on that so far have not really led to anything, but we just want to be aware of them anyway. Before I start, there's a thing called the SPXInvesting Program, and it's free until the end of 2024. You can go to the website by clicking a link below this video. There's a video that I prepared that also talks about the program. If you have any questions, you can email me. And one of the benefits you get, even right now, while it's free, is you have immediate access to the videos as they're posted, where I wait to make them go public on YouTube and Rumble. Also, I do a number of videos throughout the week, with the daily video being the real foundation and the hub of the analysis that I do. That's where we can see these incremental little changes. So we see things as they're developing. Sometimes they don't play out that way. Sometimes it takes a while for things to play out, but we can still see them happening anyway. All right, let's go back and talk about what happened. We did have a gap higher open. The futures were fairly positive, and we're just chopping around right now. We were able to get above R1 at 57.28, and then we stalled at 57.40. As the day went on, we declined back down to R1, which now became support since we went above that. And we climbed above and then closed pretty much at the 57.50 level. I think it was 57.51 where we actually closed. We were up 0.97%. So we lost, what was it, 9.96% on Monday. Now we gained 0.97% on Tuesday. I'll show you the bars, and we're just kind of in a range for the time being. And that's why we're having a little bit of trouble with our ADX, because it's picking that up and just chopping along sideways. But we're still below average with volume. Maybe it will pick up when the FOMC meeting minutes come out. We're going to get CPI on Thursday and PPI on Friday. That could be a real catalyst to pick up volume there. We are still positive in the short, intermediate, and long term as measured by the moving averages. We'll see if inflation is adjusted this week with CPI on Thursday and then PPI on Friday. Keeping an eye on the geopolitical events, specifically between Israel and Iran. Oil really fell in Tuesday's session. We'll see if it goes back up for geopolitical reasons. Okay, so the 10-year yield, we're still above 4%. And that seemed to have a bit of an impact on Monday, but didn't seem to have much of an impact on Tuesday. Mega caps and semis, which were weak on Monday, well, they did pretty good on Tuesday. So we have a good day, then a not so good day. And we're just kind of going back and forth between the two. We are keeping an eye on this escalation in the Middle East. Oil had been up around the 77 level. It dropped down to 73. And on a short-term basis, we're still looking pretty extreme with the Williams percent R, the slope oscillator, even though it's coming down below its moving average, and the stochastics are still looking extreme positive. Intermediate term, we have the PMO studies, the Sean trend meter, which is now back on the list. We're watching the bullish percent index for the S&P, but we're still getting a really high reading from that. And then the 10-period new highs, new lows for the S&P. Long term, we're still looking rather extreme. Also good momentum with the 150 and 200 period simple moving averages. Haven't changed the scenario yet. We'll see if something comes out on Wednesday, Thursday, or Friday this week to change that, but the market is anticipating a soft landing, meaning that we will not go into a recession. The dollar was up and interest rates were also up, which didn't seem to really pressure stocks all that much. We're at 4.03% with the 10-year yield, where we had been at 4.02%. Last Friday, we actually climbed up just under 4%, and then on Monday, we went above 4%. We're still inverted with the 10 to the 3 month, where the 10 to the 2 is uninverted. And we're still positive as far as sentiment. We ticked up with the up day. We had become really close to that 75 level after Friday. We were at 74. Then with Monday's down day, we dropped down to 70. Tuesday's up day, we bounced back up to 72. And our trend is still positive, but we're just chopping sideways now with the ADX. We're below the moving average. And with the up day, the bias is positive, but I'm still keeping our momentum at mixed as we continue to chop sideways here. So the economic reports that came out, we had the NFIB small business optimism at 91.5. Last time it was at 91.2. The trade balance came in a little better than expected at a minus 70.4 billion. They expected 71.3 billion, and it was down from the 78.9 billion we saw last time. Here is a chart of the small business optimism here, where it is looking pretty good right now. So things are seeing a little bit of an improvement. We had been going up into the spring and summer months and then dropped down in August, and now we're going back up slightly here. And here is the trade balance, where we're still negative, but we're a little bit less negative than we were before. And then the nominal exports and imports year over year. The imports are in yellow, coming down a little bit, but still positive, where we are pretty much flat with the exports. And then here's a look at the trade deficit, where it's a little bit less than what we saw last time. Okay, Isabel net charts, don't have really any of those to show right now from Twitter, but I'm a little out of order here with the slides here. We look at the overbought, oversold composite, where we're coming in right now at about 83.05. So we're getting up into that extreme area, but not necessarily really extreme. We've been higher than this before. And that's kind of confirming what we're seeing with some of our other sentiment indicators here. Equity positioning, we're still above the zero line. So we're above neutral for right now. Folks are still willing to position themselves long in the market for the most part. And then gold trades at 40-year extremes. We're getting up to +2 standard deviations as gold has been going up. That may signal that we are due for some kind of a pullback, but we still have gone higher than this before. And then aggregate equity futures positioning. We still have a lot of folks that are long in the market here. And then we have cut our, our recession probability back to 15%. This is from Goldman Sachs, as posted by Bloomberg here, where the consensus is they're down around the 30% level. Goldman Sachs is coming down to the 15% level. And this is the soft landing that we're talking about, that we won't go into a recession according to them. That's why we watch the economic reports, because this can change, especially if some kind of an event happens. And then looking at equity allocation, it's currently at 63%. We've been going up here. And then the unemployment rate, it could rise more. Well, we've actually been declining here, but it's been coming down here. And this is the Conference Board jobs plentiful, less hard to get. I don't know how you figure that one out, but that's been coming down a little bit. The unemployment rate has been going up, but then ticked down in the latest reading. And bond flows, we're seeing a lot of money coming out of bonds right now from October 2nd. And looking at the different flows into all bonds, where a lot of bank loans are really, that might tighten up the money supply a little bit. But we are seeing the dark blue areas here with money going into bonds, especially corporate bonds. They're more attractive now. We have investment grade bonds, the emerging markets, a little bit, but not very much there. And then munis, which are municipal bonds, seeing some flow into that. So you can just see that, and some money's coming out of tips. Now, these are Treasury inflation protected securities, which this is what folks like to get into when they're worried about interest rates going up and inflation going up. That seems to be under control. So they're getting out of these and getting more into the other kinds of bonds that a few years ago weren't very attractive, they're starting to become more attractive now. Then, improving economic surprise index suggests equities should be able to withstand some inflation upside. Well, we'll just see how all of that goes. But this is just showing when we're above zero that we compare it to the 6-month change in the S&P, which has been going up, and the surprises have been to the upside. So for right now, good news is good news. But if this really gets carried over too far, that could mean that good news might suggest some inflationary pressures, and then that could put some pressure on the stock market itself. And here is the City US Economic Surprise Index. This really shot up with the employment report that came out last Friday, and that was much stronger than expected. And so right now, as I said, good news is good news. But if this keeps going up to the point where the market is like, oh no, this is getting inflationary, then that's where good news could start to become bad news. Here's our intraday chart where we did gap up a little bit right at the open, well above the daily pivot. We got up above R1 and then just chopped along sideways. Then we shot a little bit higher. And then some kind of a sell program or something came into the market, took us back down to R1. And it looked like, okay, maybe we're going to really start to break lower. Nope, we found some support here at R1 and then saw a nice little run up going into the close. And not much of a change in the initial overnight session with the futures right now, but most of the strength that we saw actually came during the session. There was a little bit of a bounce here with the futures before the market opened, but we saw the cash market really help to take things higher. This is showing an improvement here where we're seeing the blue line now above the red line. That means growth on an intraday basis is outperforming value, even though they're on different scales here. And we are seeing more of a gradual upward move here when we compare S&P growth to value. That's if we're more positive on the market. We want to see that. Our end of day chart, growth had a really good day, up 1.52%, where value was up 0.17%. Also with the mid caps, growth was up, and growth was up with the small caps, where value was down for the small caps. So seeing a bit of an improvement here, but we need to see more follow through than what we've been seeing. The overall trend is still down when we look at small cap growth to value. Mid cap growth to value also bounced up, but not enough to change the overall downward trend. But we are looking more encouraging here with S&P growth to value. This is really going up. We haven't broken out above this previous high yet, but the fact that this is going up and still in an uptrend is positive. And seeing a little bit of an improvement with the growth versus value ETF. We're coming back up more into the middle part of the rainbow. And this is still encouraging when we look at the ratio between discretionary and staples, breaking out a little bit here, even though it was flat in Tuesday's session. This is still showing some improvement, and that's what we would like to see if we're more positive on the market. Our large cap growth ETF is still looking pretty good above all the moving averages here. This is where we're getting a little bit of frustration here because you can see the bars that we get up to a high range, then we drop down, then we come back up, then we go down, then we go back up. So we're just treading water sideways right now. Now, if you sell options like covered calls or some kind of credit spreads or something like that, you like this. You want the market to just chop along sideways because incrementally you're making a little bit of money every day. If you're a trend-based trader, this is more frustrating for you. Well, we have the ADX still pretty much on top of the moving average. We're still above 20, so it's a trend, but not a very strong trend. In fact, there's virtually no trend you can see by looking at the chart. We're still positive here because the green line is above the red line. We're seeing kind of that same thing here in the short term, dropping a little bit below the moving average. We're still positive with the green line above the red line as well. And volume continues to be below average. There's not an awful lot of conviction right now. Now, I'm going to go through some different aspects of the VIX and kind of put this together here, where we declined in Tuesday's sessions, but we're still above 20. And that's kind of the dividing line here between positive and negative for the VIX. So since it's above 20 on a closing basis and also the bar charts, we're a little bit concerned about that just in and of itself. And we did decline a little bit, but we're above the moving average when we look at the VIX of the VIX here, and also decline, but still above the moving averages when we look at the closing value. This is where we're starting to see something that could be a concern. The VIX to S&P 500 correlation, it's been giving very low readings lately. Well, now it's starting to shoot up and it's going above this dashed line here. And this can be another way of saying, okay, the market is looking kind of nervous right now. Now, this could still go up further from where it's at right now, but since it's crossed above this dashed line, we want to keep an eye on that. So typically, if you look at the different times, where I've marked this when we had a spike in this correlation and then what the S&P did after that. Sometimes this marked the top. Here's one time when it actually marked more or less a bottom here. But typically this tends to be negative. We just want to keep an eye on that. And the momentum of the VIX is also going up now as we're still above 20. Even though it declined, we still closed at 21 after Tuesday. And here is where we're looking at the seasonality of the VIX that really hasn't kicked into gear much according to what typically happens right now. We're wondering if that's just kind of laying in the background and will kick into gear. And here's the skew index, which is a variation of the VIX, where the VIX uses at the money options to be calculated. The skew index uses out of the money options, and we're still getting a high reading. It's coming down, but we're still up into this red area. So to take all of this together, we have the VIX above 20, we have the correlation giving us a warning sign, and we're still getting an extreme reading here. The context, at least to default to right now, would be negative, that this could end up putting some pressure on stocks. Now, we could be wrong with that. We want to see confirmation based on price before we make any conclusions based on that. But when we see all of these things coming together, that is causing us some concern with this positive backdrop that we've been seeing with stocks, even though we've been chopping sideways. And we declined a little bit here with this fear gauge, declining a little bit here with this other fear gauge because we had the up day. Looking at the risk on versus risk off ratio, we are continuing to go up. That's more positive since stocks had an up day. And we're declining a little bit here on the daily chart with the equity put call ratio. We're continuing to go down with the 5-day, and we're going back up with the 10-day. So we're getting some mixed signals there. That's not really giving us a lot of insight currently. But when you look at the volatility risk premium, we're starting to get a very high reading. So we can take this and combine it with the other things that we're seeing with the VIX, and this is making the market a little bit nervous right now. The advanced decline line still looking pretty good, but has not broken out to new highs yet. We're still above the advancing moving average based on price and volume. And the new highs, new lows falling back a little bit. So we're declining slightly with our 5-day and our 10-day, but you see a lot more green here than red. So overall, that is positive. We're still looking good here with the accumulation distribution. We actually went up and we're above an advancing moving average, and we're not necessarily extreme with the boom indicator. After slightly dropping negative with the 19-day advanced decline ratio, we now cross back above zero, and the red line ticked up slightly. And so we're back above zero here with the breakout based on price. We never did go negative based on volume, so that is positive. And the chicken money flow is declining with the histogram, but we're still going up with the moving average here. If we see more weakness, it could roll this red line over, and that would turn things more negative, where we're just chopping around now. Looked like we were showing an improvement with the Chaikin oscillator. Now we're just back to going sideways here. And the vortex is still positive. We're flattening out with the green line, turning up slightly where we declined a little bit with the red line. Longer term, with the 10-day average of the highs and lows for the S&P, we're still getting a very high reading. So that is still positive there. When we look at the advanced decline line for the S&P 500 on a cumulative basis, we did decline, or excuse me, we went up just a little bit here. We're still looking pretty solid and just about ready to break out based on volume. So this is holding up for right now. These warning signs that we're seeing with the VIX, we're not seeing really any confirmation yet based on price. There are just these negative things that are in the background that we just want to watch to see if they do develop into something. And we saw a little bit of a disconnect here with the S&P since it was up, and we actually went down a little bit here with the NYSE advanced decline line. Still looking pretty good here with the new highs minus the new lows on the daily score for the S&P, and still declining just slightly with the 50-period moving average. The NYSE new highs, new lows, also coming down, but getting a positive answer there. The 50-day is also not really moving all that much. It was down ever so slightly. So we saw a little bit of a pullback here with the cumulative advanced decline line for the NYSE, a little bit of a decline here with our regular NYSE advanced decline line. Just want to keep an eye on this just to see, is this some weakness in the broader market that's starting to come in? And our other NYSE advanced decline line also declined as well. And we break this out based on common stocks, seeing a bit of a decline here, a little bit more based on price than the intensity that we're seeing with volume. But we're still looking good with our advanced decline line studies. We were pretty much flat here with the NYSE common stock, up a little bit with the S&P, declined slightly with the mid caps, and coming back down to the moving average with the small caps. Then we look at the 5-period moving average of the highs and lows across the broad market. It is declining, but still above zero. Looking at the ratio between large caps and small caps, we are going back up, but we've been just chopping around pretty much going back to the beginning of the summer months. And after dropping a little bit below 50 with those stocks in the S&P above their 20-period moving averages, we're crossing back slightly to positive now. We ticked back up and we're still positive with the 50-day moving average, the 100-day moving average, and we're still declining with the 200-day moving average study. Short term, we're just chopping around sideways more or less here on below average volume. So we ticked up a little bit with the 20, 50, and we're flat with the 200-day moving average on the S&P. After getting extreme negative with the Stochk RSI, we did bounce back up, but we're still below the midpoint. We're starting to get extreme here with the Williams percent R, but this can go up and stay here for a while if we see more upside with the S&P. Still looking positive, but not extreme with the CCI 14 and the CCI 20. We're getting extreme now with the short-term stochastic, turning back up, but not extreme in the intermediate term. We're still below the moving average, but extreme positive in the long short-term stochastic. And after slightly crossing over negative, we bounced back up positive with the force index. But we're still pretty much underneath these lines here. When we look at the condition of our 20-period moving average, we're below both the green line and the blue line currently, but we're above the simple and exponential moving averages here. So until we drop down below and close below one of these, or actually both of these lines, since they're on top of each other right now, we are still positive. And we're just on the border between the +1 and +2 channel with our standard deviations chart, but we're above the midpoint, so that is positive there. We did tick up, but we're still negative with the balance of power. The condition of our 50-period moving average, we're coming back above the red line and the blue line, so that's showing some improvement intermediate term. And we're still positive with the go, no-go with the darker blue bars, and we're above the midpoint and coming up to the blue line here with the highest high value. That's still positive. But the TTM squeeze continues to decline. We have the darker blue bars, and they are going down. And we're still above zero here with the ease of movement. So that remains positive. We're still flat with the Erin. It's just not moving much these days. And then with the S&P McClellan oscillator, we got all the way down to this extreme reading here. We did bounce back up, but we're still below zero. So when that happens, we're still declining with the summation index based on price, and we're also declining based on volume. And we ticked up a little bit with the NYSE McClellan oscillator, but we're still below zero. So that's negative. So we're seeing the summation index for the NYSE decline based on price, a little bit more intensity than what we're seeing based on volume, but they are both declining. We ticked up, but we're still negative with the Swenlin trading oscillator based on price. We actually bounced up off of the zero line here based on volume. That can be taken as positive for right now. We're seeing volume holding up a bit better than price right now. But the momentum, we're starting to cross below the moving average with the PMO. We've already gone negative based on price, dropping a little bit below the moving average here based on volume. So not much of a change here with the PMOs that are rising, still declining with the buy signals, coming down a little bit, but still extreme positive with the PMOs above zero, which, as I explained in yesterday's video, you could still take this as positive. That's all the stocks in the S&P using the PMO. Most of them are still above zero. So they're holding up for right now. And we've gone from being negative to positive with the Elder's Impulse system for the S&P, but we're still negative with the parabolic SAR. and we're declining. We're getting back down close to this green line here. We're still extreme with the slope oscillator, but this is declining. And we're also below the moving average here with the MACD. So in the short term, looking a little more negative with the slope oscillator, the TSI not really crossing quite as negative yet, but the MACD is below its moving average, the PMO coming down to its moving average, the PPO a little bit below its moving average, rolling over and not quite turning negative with our long-term oscillators, the TRIX and KST. But we are negative with the Copic curve. So that is negative on a momentum basis. And we ticked back up into the initial extreme positive area with the Sean trend meter. We declined a little bit here, but we're still above 50 with the money flow. We went up and above 50 with the ultimate oscillator. We're still above all of the plotted moving averages here. And we are declining with the bullish percent index, which is kind of strange. We had an up day, but this is actually continuing to go down slightly here. And we're getting a pretty extreme reading. And you can go back and see when we had extreme readings and what the S&P did after that. And quite often that ended up being negative. The NYSE bullish percent index came down a little bit, but still giving us quite a positive reading here. The bullish percent index for the NASDAQ 100 did decline, but we're still above 50. And we're just chopping along here. This is on balanced volume, but we're still above an advancing moving average. We're above 50 with the RSI 14 and the RSI 9. So that shows short to slightly intermediate term momentum remains positive there. We're above this short-term mini rainbow here, which is a 20-period moving average of the high, open, high, low, close. We're still above that, and the lines are still going up. Long term, we're still looking pretty solid there, even though we've been chopping sideways. And we're kind of flip-flopping around. You can see where we have a dark candle, then an open candle, then a dark candle, then an open candle. With the Heiken Ashi chart, we're positive since we're black and pointing up with the Kegi chart. The Renko chart is still positive, and the three-line break. Also, a lot of indecisiveness. Black candle, open candle, black candle, open candle. Long term, coming down a little bit here, but we're still above this red line with the 150 and 200-day moving averages here. And we're negative in the short term with the small caps. All of the other indexes with the SPY mid caps and the QQQs remain positive on all time frames. And bonds are still negative in the short term based on price. Commodities are seeing an improvement in the short and intermediate term. And the dollar has now switched to a short term uptrend. And we just had materials and energy. It got hammered really bad. Energy did. That was a large part of the drop that we saw in oil. But we saw tech doing quite well, discretionary and communication. These are the three main growth areas. But we need to see more follow through for this to turn more positive. And we started off kind of positive here. We had a BPI cross above 70 with discretionary. Okay, we like that. That's more of a growth area. We got back above 5,700 with the S&P, back above 18,000 and then 18,1, and then we crossed below 18,1 and below 18,000 with the NASDAQ. And the Dow was able to get above 42,000 here and seeing a little bit of a pullback right now in Canada. And not really seeing much of a disconnect here between the S&P 500 weighted versus the equal weight index right now. They both advanced. And we were up 0.73% with this ratio, but we're just chopping around right now, not really showing any kind of leadership, which you could take as negative because we want the big mega caps to do better. That's when this ratio goes up. But the fact that this is holding up fairly well means that the rest of the stocks are participating more. The Dow was up 0.3%, but not back to an all-time high yet. We've gone from negative to neutral with the Elder's Impulse system with the diamonds. The NASDAQ was up almost 1.5%, not hitting a new all-time high, not even breaking out above this previous high, let alone the all-time high that we set over the summer. But for right now, this is holding up. And the NASDAQ 100 was up over 1.5%, also holding up for the time being, but still has a ways to go to get back to an all-time high. We've gone from neutral back to positive with the QQQs with the Elder's Impulse system. We're right on top of the moving average here with the NASDAQ 100. The momentum is pretty much neutral until we either break back above the moving average, that would be positive, or we break down below the moving average, which would be negative. Small caps ended up being slightly unchanged, coming back down close to this pivot level, but still above their 50-day moving average. So looking at the Russell 2000 small caps, we're right at 50 with the RSI, still above the 50-day moving average based on price, still negative with the momentum. And we've gone for a second day now of being negative with the small caps. Mid caps also just chopping sideways these days, and they still remain neutral. When looking at the Elders Impulse system, had a nice move up with the Wilshire 5000, but not back to an all-time high yet, but we're still well above the 50-day moving average. And pretty much the same thing here with the total US stock ETF, holding up pretty well for right now. The staples to tech ratio continues to go down because staples didn't perform as well. Tech had a pretty good day, but we're still seeing a recent golden cross here with this ratio as staples are in an uptrend when compared to tech. Financial sector was up and still looking pretty solid there. The FANG index was up over 2%, but not back to an all-time high yet. Apple was up 1.84%, still above its 50-day moving average. We were up over 1% with Amazon. Microsoft, which we're watching this here, even though it was up 1.25%, we might be getting ready to see a death cross here. Google was also up not quite 1%, but still above its 50-day moving average. Meta, which as I usually comment here, this is about the best looking chart that we see at this time. It was up 1.39%. Nvidia was up over 4%, bouncing off of its 50-day moving average. Tesla was also up 1.5%. We're in an uptrend here with a recent golden cross, but we haven't broken out to a new all-time high yet. And Netflix was up 2.83%, also a pretty good looking chart right now. We're seeing a little bit of an improvement on a short-term basis with the US stocks versus world stocks when we look at a 10-day correlation, and we're pretty much going sideways here with the longer-term correlation. This is oil. It really dropped down 4.63%. It had been up into the 77 range. Now it's dropping into the mid 73 range. The dollar is still in a downtrend, but continues to go up after coming down to this 100 level. And we're still going up with the 10-year. Here's above 4%. So we're continuing to go down based on price of the ETF here. And seeing a little bit of an improvement with the Qs to S&P with our growth to value ratios. Discretionary versus S&P starting to fall below the moving average. Even though we've liked what we've been seeing with discretionary lately, we're not seeing that confirmed by this chart, and seeing a little bit of an improvement when we compare large cap growth to large cap value. So with the large caps, we're coming up above the moving average. Mid caps had a pretty good move up, and small caps as well. Are we going to see any follow through here? But overall, even though we went up here, we've been declining when we look at the S&P to utilities ratio. It would be more positive for the S&P if this ratio was going up. And for the most part, it's been going down. And this is encouraging for the S&P. The Staples to S&P 500 ratio, we are continuing to decline here, which is more positive for the S&P. And then just an update of this chart. There's been no changes here with the Hindenburg Almond. We haven't received any more confirmation signals there. So we are still positive, but we're chopping sideways now. We do have this Hindenburg Almond and weak seasonality, which hasn't seemed to matter. And we're watching these VIX signals, and we're seeing a lot of them right now at the same time, and they're flashing. Now, you could default to negative, but we're not really seeing any confirmation of that yet in our charts. We're going to get the MBNA Mortgage Applications Index. We get that every week, wholesale inventories, and then at 2 p.m. Eastern, we will get the FOMC meeting minutes. And we want to keep an eye on all the crazy stuff going on, specifically in the Middle East, if there's more of an escalation there. And here's the economic calendar. I'm not quite sure why this blue border is around this, but on Thursday, we're going to get CPI. Friday, we're going to get PPI and consumer sentiment. And so here are the previous readings here. And we don't really know what's going to happen with the FOMC meeting minutes. Will there be any surprises there? We're positive on October 9th when we just look at the Dow, and we're neutral to positive with the S&P and NASDAQ. We are on the seventh trading day of the month, where we often see some negative seasonality during an election year. And Wednesday, at least based on what happened in 2023, was the most negative day of the week, but it's like the least positive day so far in 2024. And we're also keeping an eye on this yellow area. And then I have the red box going in here as we go into October and eventually into November, where we quite often see weak seasonality, but it just has not materialized. So we still have this Hindenburg Omen and weak seasonality that remain in the background, which may become a non-event, but about the time we write them off is when they might kick into gear. So we just want to be aware of them, even though we're not really seeing any confirmation in our charts yet. We're watching the defensive sectors. We're staples, utilities, and healthcare. Those are the more defensive areas, and we're keeping an eye on energy, mainly for geopolitical reasons. We're watching growth of value, which did show some improvement for the S&P. Discretionary to staples, showing a bit of an improvement there when we look at one chart, but not much of an improvement with the other chart. And we're watching these multiple VIX signals just to see if they're going to lead to anything here. We're still negative with the S&P and NYSE McClellan oscillators and summation indexes. They did bounce up, but they're both still below zero. And the 10-day equity put call ratio is going up. That is negative. We're diverging with the Swenlin trading oscillator. And the parabolic SAR is negative, and our oscillators are turning more negative as well. On the positive side, still looking pretty good for the time being with our three smart money indicators: accumulation, distribution, Chaikin money flow, and the Chaikin oscillator, even though the Chaikin oscillator is pretty much chopping sideways. And the 5-day equity put call ratio is continuing to go down. The advanced decline line is still holding up for right now. We're still extreme with the bullish percent index for the S&P, getting quite a high reading with the NYSE bullish percent index, and still looking positive with the NASDAQ 100 bullish percent index. The vortex is positive. Be nice to see more strength from that. The money flow, ease of movement, and ultimate oscillator, they are all positive. And we're right on top of the moving average now with the NASDAQ 100 momentum. I'm keeping it positive until we decisively drop below that moving average. And the financial sector is still looking pretty good right now. So our conclusion: we are still positive, but we have these negative things in the background that haven't really developed into anything, at least yet. We are chopping sideways, and we want to keep an eye on what's happening with the VIX. In the short term, that's mainly where we're chopping sideways. In the intermediate term, we're still positive, and we're watching the VIX signals more for that area as well, but we're still positive in the long term. Thank you. I really hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.